So there are three big trends or developments that we're looking at for in March. The first is the direction of the US economy. The second is the ECB meeting next week that probably will have to see the ECB engage in large easing. And finally, the current rally in crude oil prices. So what we've seen with US data recently is that the survey data, much as it has across the rest of the G10, has been heading south. So most of the PMIs and most of the surveys that we've seen from the United States indicate a growing degree of pessimism amongst a wide variety of businesses. However, we've still got a number of indicators from the US economy that are performing very well, most notably personal consumption expenditure, inflation, vehicle sales, and actually wage growth in general. So the question in March for the US economy is, will survey data begin to pick up as consumers spend, or will those other indicators begin to catch up with business sentiment, and will we see a substantial slowing in the US economy? Moving to the Eurozone, the European Central Bank is in a really, really difficult situation, given that its December meeting has failed to prop up inflation expectations. So the ECB can now choose. It either engages in extremely large and open-ended easing measures, including deposit rate cuts and an adjustment to its quantitative easing program, or risk seeing inflation expectations in the Eurozone completely fall to pieces. So we expect really moving into March that the ECB will engage in the large easing that markets were expecting in December, and the reverberations of that, particularly in commodities and global markets, fixed income, will be a major trend to watch in March. Now, crude oil prices are rallying pretty powerfully at the moment. They're up some 30% from their lows this year, and in our view, this rally may not actually be sustainable, because if you look at the fundamentals of the oil market, we've had major producers from Saudi Arabia to Russia say that they want to freeze production at 2016 levels, as if that's going to support prices. But the reality is these production levels represent close to all-time highs. So really what they're saying is the market's in oversupply, we've got all-time production highs, and we're just going to keep doing that. In the meantime, we've had Iran suggest very strongly that it will not freeze production and will instead attempt to regain some of the market share it lost during the sanctions period. So if you add all of this up, you've got a market that's fundamentally oversupplied, and that's being supported by stockpile data in North America, for example, and you've got producers promising to maintain or increase production. So the crude oil rally that we're seeing at the moment may begin to start looking quite stretched in March, and if we see a reversal, certainly how that affects risk appetite will be worth watching.